For the past few years, crypto investors have been conditioned to expect disappointment. Every rally faded. Every breakout failed. Every altcoin narrative seemed to end the same way. But something feels different right now. Not because prices are soaring, because they're not, but because underneath the surface, we're seeing a combination of macro conditions, institutional activity, and blockchain infrastructure that hasn't existed together for years. Even after Bitcoin's recent pullback, the broader market continues showing signs that this cycle may be following a much healthier path than many expected. Altcoins are beginning to flash technical signals they haven't shown since the last cycle. Institutional money is quietly rotating, and while most headlines focus on short-term price action, companies are quietly building the financial plumbing that could support the next phase of crypto adoption. Today, we're breaking down why several respected analysts believe crypto may be entering one of the healthiest environments since 2020, why XRP continues expanding beyond payments into on-chain credit markets, what ETF flows are telling us, and why one surprising on-chain metric suggests retail interest might be returning. Let's get into it. Nothing in this video is financial advice. Always do your own research before making any investment decisions. Welcome back to Ledger Pulse, where we break down the biggest developments shaping crypto without the hype. If you enjoy level-headed market analysis that connects the macro picture with what's happening across the industry, be sure to subscribe. Now let's start with the bigger picture. One of the more interesting observations this week comes from Matthew Hyland. His message is simple. Crypto investors may be looking at one of the strongest macro environments we've seen in years. Now obviously, nobody knows the future, but the reasoning behind his argument deserves attention. He points out that many of the macro conditions that pressured risk assets over the past 4 years are beginning to improve. Inflation has cooled dramatically compared to its peak. Interest rate expectations have become more favorable. Liquidity conditions continue improving. Corporate earnings remain resilient. Meanwhile, traditional equity markets continue making new highs. Historically, crypto performs best when investors are willing to take more risk. It's rarely just about Bitcoin. It's usually about the broader economic environment becoming supportive. He also highlighted several indicators, including Bitcoin dominance, PMI data, copper versus gold, and broader market trends that resemble previous periods where crypto entered stronger phases. No indicator guarantees future performance, but when multiple macro signals begin pointing in the same direction, it's worth paying attention. Markets often begin shifting long before the average investor realizes conditions have changed. Another respected analyst, Psychedelic, focused specifically on altcoins, and he acknowledged something many investors have been feeling. The last several years have been brutal. Many altcoins remain far below their previous highs. Confidence has been damaged. Entire communities have disappeared, but markets tend to create maximum pessimism near major turning points. The technical signal catching his attention is the weekly MACD. For the first time in more than 2 years, that indicator has crossed back into positive territory. So here's what it actually means. Momentum is beginning to improve. Historically, major trend reversals often begin with momentum strengthening before prices make their biggest moves. Psychedelic pointed out that a very similar setup developed during 2020, shortly before altcoins experienced explosive gains. That doesn't mean history has to repeat itself. Markets never move exactly the same way twice. But the current structure resembles what many analysts view as a healthy mid-cycle reset rather than the end of an entire bull market. It's another piece of evidence suggesting patience may eventually be rewarded. While price action dominates social media, Ripple and developers building on the XRP ledger continue expanding infrastructure. This week, Ripple published a detailed breakdown of the XRPL lending protocol. And this is significant because it introduces standardized lending directly at the protocol level. Instead of every platform creating completely different systems, developers now have common infrastructure to build upon. The design separates underwriting from execution. Institutions can evaluate borrowers off-chain using their existing compliance processes. Once approved, loan execution, repayment logic, and settlement happen on-chain. That hybrid approach solves one of the biggest challenges institutions face. They want blockchain efficiency without sacrificing regulatory compliance. The XRP Ledger Foundation also announced work alongside VSG Finance on an open-source reference application demonstrating how permission lending can operate using native XRPL features. These include single asset vaults, permission domains, credentials, and native lending protocol functionality. Think of this like building highways before traffic arrives. Infrastructure rarely creates excitement overnight, but it's often what enables future adoption. Instead of asking institutions to completely change how they operate, developers are increasingly building blockchain tools that fit into existing financial workflows. That could significantly reduce barriers to adoption. One post this week summarized the idea perfectly. Credit becomes infrastructure, not just another application. That's an important distinction. Traditional lending systems rely on multiple intermediaries. Every participant keeps separate records. Settlement often requires several organizations. Different systems communicate through layers of reconciliation. The XRP lending protocol attempts to standardize those processes. Liquidity can be pooled into standardized vaults. Loan terms become programmable. Repayment logic becomes automated. Developers can build applications on top of common infrastructure instead of reinventing everything from scratch. It's similar to how the internet evolved. Companies eventually stopped building proprietary networking protocols and instead built products on shared standards. Financial infrastructure may be following a similar path. We're still early, but these are exactly the kinds of developments institutions tend to care far more about than short-term token prices. Another data point worth discussing came from ETF flows. Bitcoin spot ETFs experienced net outflows. Ethereum also saw money leave. Even Solana recorded modest outflows, but XRP stood out. It posted positive net inflows while several larger digital assets moved in the opposite direction. What's especially interesting is that this isn't an isolated event. Over the past several months, we've repeatedly seen XRP attract fresh investment during periods when other digital asset ETFs were seeing capital leave. It's becoming a recurring pattern rather than a one-off headline. That doesn't automatically mean XRP will outperform from here. ETF flows can change from week to week, and no single metric predicts future price action. But consistent inflows over time suggest institutional interest hasn't faded. If anything, they indicate that some investors continue using periods of market weakness to increase exposure rather than reduce it. It's another piece of evidence that while retail sentiment remains cautious, certain institutions appear to be taking a longer-term view. And once again, it's one more data point that fits into the larger picture we've been building throughout today's episode. Santiment shared another metric worth watching. New XRP wallet creation recently reached its highest level in months. Nearly 5,000 new wallets were created in a single day. That's notable because network growth often improves before price does. Think about opening a new shopping mall. You don't judge its success on opening day. You watch whether more people continue walking through the doors. Blockchain networks work the same way. Growing wallet creation doesn't guarantee immediate price appreciation. Some wallets remain inactive. Others belong to institutions. But sustained network growth generally reflects increasing participation. Interestingly, this growth is happening while XRP trades near a major psychological support zone. That creates an unusual contrast. Price remains relatively subdued, yet on-chain activity continues strengthening. Sometimes markets don't recognize those divergences until much later. Individually, none of these developments guarantee anything. Macro conditions improving, technical momentum strengthening, institutional ETF inflows, growing wallet creation, and new lending infrastructure, any one of these could simply just be another headline. But when several independent indicators begin moving in the same direction, they're worth paying attention to collectively. This is exactly how larger market transitions often begin, not with explosive headlines, not with retail FOMO, but quietly. Infrastructure expands, liquidity improves, institutions continue building, technical structures recover, then eventually, markets begin pricing those changes in. Whether this becomes the next major leg higher or simply another chapter in a longer consolidation remains to be seen. Nobody can predict markets with certainty, but today's crypto landscape looks very different from the environment we experienced throughout much of the past few years. Builders continue building, institutions continue participating, developers continue solving real-world problems, and macro conditions appear far more supportive than they have been in quite some time. The question isn't whether every project will succeed, it's whether the broader foundation being built today eventually supports the next wave of adoption. That's exactly what I'll be watching here on Ledger Pulse. If you enjoyed today's breakdown, be sure to like the video and subscribe so you don't miss future updates. and let me know what you think in the comments. Do you believe the market is quietly setting up for the next major move? Or do you think we're still headed for more consolidation before the real breakout begins? I'd love to hear your perspective. Thanks for listening, and I'll catch you in the next one.